We're just seeing there's more money coming into the markets than we've seen in the last 2 years. What about you? I know you have about 1,000 high net worth individuals that you advise on their portfolios. Are you telling them to get more cash off the sidelines and put more of that back in the markets?
Well, we already have. What's interesting about, there's chatter about Goldman's recession probability coming down to 20%. Talk about whether it'll be a soft landing. Maybe there's a hard landing out there. It's already happened, right? We had 6% GDP growth in 2021. We've been at 1% since. And inflation's come down from 9 to 3%. The Fed isn't leading inflation. They're following inflation. So the whole complex is coming down, wages, et cetera. And so as deflation or disinflation takes root, which has happened,
right,
on average, markets return 3 times more than during inflationary environments. So there are places in the market that maybe have run a little far, but there are a whole lot of other places in this market, the non-S&P, where the PEs are very reasonable, and we're probably slipping into expansion, not recession.
All right, David, so I'm going to push back on you for a bit. So I think everybody agrees that the market is expanding. We saw industrials and consumer discretionary hit a 52-week high yesterday, talking about sectors. But you're saying there's spots outside of the S&P where the valuations are more attractive and you see more upside opportunity. So please be specific. Is there certain sectors or certain stocks? What are you looking at?
Well, the first half of the year was all about hype and the return of optimism. And that accrued to the benefit of the mega stocks, the Magnificent Seven, they've been called. The other stocks didn't really participate, right? So there's a 10% spread between the S&P cap weighted and the equal weight. I mean, the cubes are up, what, 40%? So it's possible that all those stocks go up another 40%. But here's a spoiler alert. If you look at the Mega Seven, the Magnificent Seven, and you look at forward earnings, 5 of them have earnings growth rates anticipated to be less than the earnings growth rate overall for the S&P. So
David,
there are other ways to play.
I get what you're saying. I get what you're saying. But is there one sector that you're looking at where you really see these opportunities? Because a lot of people talk about the valuation of the S&P 493 being about 20 times when you look at the mega cap, Magnificent Seven, whatever you call it, 30 times. So what's attractive when you look at that 20 times forward PE? What areas do you see the biggest upside?
Well, financials have been beat up, right? And in the financials, the XLF, if you will, 25% of that is banks, 75% is other stuff. So it'll be very interesting to see what we get out of Schwab and Morgan Stanley, et cetera, if the negative GDP sort of chatter is behind us and positive GDP chatter is ahead of us and rates are coming down, then that could accrue to the benefit of earnings within financials. So, so far this month, they're up about twice what the S&P is. Maybe a trade, not an investment, but there's opportunity there, I think.
So you like the financials. Speaking of that, we're in the middle of earnings season. We do have 2 of those big banks reporting later. I want to bounce this off of you. The forecast for this quarter is an 8% decline year over year in earnings. But so far, earnings are almost 11% above estimates. What does that tell you about the market? And maybe even more importantly, what does that tell you about the economy?
Well, I think there's a difference between government, economy, and companies, right? And companies have had 2 years to prepare for a recession that never came. And so they've done a lot to trim payrolls, to restructure. And so you'll see these earnings surprises. We had a big earnings surprise number last quarter, a big one this quarter. And so you're right, earnings may be negative to the quarter, but it's not reality that makes markets move. It's the difference between reality and expectations. And with low expectations right now, as you're saying, reality coming in above that, that's rally fuel. And as you said, some cash is coming back to work, but there's still $5.5 trillion on the sidelines looking for rates of return. And as money market rates come down over the next 12 months, it's going to make people more interested in the stock market. There's just plenty of rally fuel out there.